for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Hey team, good morning. Welcome back for another episode of Wealth Coffee Chats. Now, if I sound a bit croaky or a little off, it's because I've been hit with a case of man flu, most likely from the petri dish that is daycare. If you've got kids, you'll know what I mean. So if you hear a bit of a sniffle or a slightly croaky voice, I do apologise. Just know I'm pushing through for you because the wealth building doesn't stop even when your sinuses are weeping. But today we're getting into something that's been around for a long time, but more and more investors are asking about it, and we're talking about syndicated property investing. So it's really just a fancy way of saying buying property with other people. So whether it's with family, friends, business partners, or a group of like-minded investors, pooling your money can open doors to property opportunities you'd probably never reach on your own. So we're talking about things like better locations, stronger yields, bigger assets, and sometimes commercial-grade returns. But with that power comes complexity. When you invest in a group, you're not likely just buying bricks and mortar. You're also entering into a financial relationship with others. And just like any relationship, it's all fun and games until someone wants out and things aren't clear. So hopefully by the end of this chat, you'll know exactly how group investing works, when it makes sense, how to do it the right way without blowing up your friendships or your tax return as well. All right, so let's go with the basics. So what do we mean when we talk about syndicated investing? So at its core, it just means a group of people coming together to invest in property. So you're pooling capital, so that might be cash, it might be borrowing power, or both, and you're buying an asset under a shared structure. So it could be three mates, each chipping in $200K to buy a $1.5 million commercial space, a family pooling funds to purchase a duplex for an NDIS property, a lead investor creating a syndicate with a few passive investors where the lead manages the deal and others are just tipping in the funding, or even something informal where it could be like a couple of siblings buying together to get their foot in the market. So I guess the benefit, together you can go after the high value, high quality assets, stuff you probably wouldn't touch on your own. And you're not just combining money, you're also sharing risk, responsibility, and sometimes even capability as well. Now, because how you own the property matters just as much as the property itself, this is where it gets really important. So there's a few different ways you can structure your group ownership, and each one has different consequences for tax control and also flexibility. So the first one, the first two I'm sure we're really well aware of is joint tenants. So this is the simplest way. Everyone goes on the title. Each person owns an equal share. If one of the owners passes away, their share automatically transfers to the other owners. Now, this is fine if you're married or partnered up and want that to happen. But if you're investing with mates or family and want to share it to go to your estate or your kids, then this is not the way to do it. So it's clean, but it is inflexible. And the next option is tenants in common. So this gives you a bit more flexibility. Each person owns a defined portion. Could be 50-50, could be 70-30, whatever you agree on. You can also will your share to whoever you like, which makes estate planning easier, but you're still on the title. And that means if one person wants to sell or refinance or changes their mind, everyone has to be involved. So it's a bit like owning a car with 3 people. Sounds okay in theory until someone doesn't want to pay the regio. Now, next option is company ownership. So this is where people kind of getting clever, but sometimes get caught out. So in this model, a company owns a property and each investor owns shares in that company. So it's neat from a control point of view, great for succession, but one of the kickers is that companies don't get the 50% CGT discount. So that means when you sell and make a profit, you're paying the full freight on the gain. So either the 25 or most likely the 30% tax rate. So there are some ways where you can use franking credits, but it's not always tax efficient and it will depend on your circumstances. And the last option, and the one that we'll be focusing on today, is unit trust. So with a unit trust, the trust owns the property. Each investor owns units in that trust, a bit like shares, so similar to a company in that regard. And the number of units you hold determines how much income and capital gain you're entitled to. So it's flexible, it's scalable, it doesn't put everyone on the title. And with a proper corporate trustee, so that's a company that acts as a trustee for the trust in place, you can have control, protection, and also clear ownership. So how does a unit trust actually work? So let's say we've got 4 people investing together. One puts in, or let's say Sam puts in 300K, Mia puts in 200, Tom puts in 100K, and Leah puts in 400. So we've got 1,000 units in total, and those units are divided based on how much each person is contributing. So Leah gets more units. She's putting in the 400, and Tom gets fewer because he's only got the 100. So there's a unit register that determines everything. So that determines who gets how much rent, who pays what share of expenses, and who's entitled to how much of the capital gain if the property is sold. So all of this happens off title. So that means if one person wants to sell their stake, they can sell their units without touching the actual property title. So that's pretty big in the fact that I guess we're not having to do stamp duty again and having to go through that whole, in effect, sale process. And with a corporate trustee, XYZ PTY Ltd as trustee, you can manage the decisions clearly through directorships rather than everyone trying to co-manage a property. I guess it's a bit like a bad group project at uni. Okay, so one thing to clear up too is the capital gains confusion that can arise from this, because this is where I guess investors kind of get mixed messages. If the unit trust sells the property, can you get the 50% discount? And the answer is it depends. If the unit trust is a fixed trust, which means that the ownership is clearly defined and unchanging, and the capital gain is distributed to individuals, then yes, those individuals can apply the 50% discount, provided they've held their units for more than 12 months. So the trust itself doesn't apply for the discount, it's the individual who gets it. So that's always got to be clear that it's the individual that gets the 50% CGT discount. Now, I guess a common twist on that is, what if you own those units in the unit trust through a discretionary trust, which makes a lot of sense? Can the discount still flow through? And the answer to that is yes, it can, but there are some rules that you need to make sure that are followed. And I guess it's best to speak to your advisor about that. Now, one other thing is that sometimes you can have a self-managed super fund own units in a unit trust as well. So something maybe to speak to the financial advisory guys on that. So if it's all done correctly, the discount can be preserved and flow through to the end beneficiary. But if it's not done correctly, you could lose access to that discount entirely. So just be careful. It's very much on the table, but just make sure you've got everything set up properly and you're documenting everything correctly along the way. Okay, so why would we go to all this effort? I mean, why bother with trusts and units and trust deeds and corporate trustees when you could just buy something in your own name and be done with it? Well, here's the thing, I guess, that unit trust open the door to a level of property investing that most people can't access solo. And when done right, the benefits can be quite significant. So we'll go through them. So probably the most obvious one, as I've already said, is pooling resources with others can get you into deals that are simply out of reach on your own. So instead of that sort of like 800K townhouse in an outer suburb, suddenly you're looking at maybe a $2 million commercial site with long-term tenants, or a duplex in a blue chip location, or even a specialist disability accommodation that's paying 10% yield. So these are assets that can offer better rental returns, potentially stronger growth prospects, and often with less tenant risk. And I guess the only reason that you can't get them is because you're going in with more firepower together. And the next one is defined ownership, clearly documented. So unlike a joint title where things can get messy with who owns what, who paid what, with a unit trust, it's all tracked clearly through the unit register. So if you've put in 30% of the capital, you get 30% of the units. If someone tips in less, they get less. So it's not about who shouted lunch or who paid for the pest inspection. It's a mathematical record, which means that there's going to be fewer disputes and less grey areas later on. Now, flexible contributions and control. So this is a big one. Let's say you and a friend want to invest together, but you've got 300K and they've got 100K. So with the units, that's easy. You're just getting 3 times the number of units. So you're both accessing the same deal, but I guess it's just the proportion of the return then is dictated by how much you put in. So this is great for family investing too. Parents can put in equity, kids can contribute to serviceability, and then everyone can own an appropriate share. Plus, if you use a company or a corporate trustee, you can centralize control with the directors, which also avoids needing to get every unit holder's signature on every little thing that you do. Next one is the entry and exit into it. So this is quite a big advantage, especially as portfolios grow. If you're on the title with someone and they want out, you usually have to refinance, change ownership, or even sell the property. But any unit trust, the property stays where it is, and the unit holder can just sell or transfer their unit. So in some states, that doesn't trigger stamp duty. So just make sure you check on whatever state that the property with that trust is in. But it's much easier to manage the transition, so the exits and onboarding of any new investors without disturbing the actual asset itself. Next one is asset protection. So because the property sits inside the trust, and especially where there's a corporate trustee involved, you're separating your personal liability from the investment. So if something goes wrong, say in your business life, say you're sued or go bankrupt, your units in the trust are still a separate asset. So they might be vulnerable depending on the specific legal scenario, but the property itself isn't your name, which is a big layer of protection. The next one is succession or intergenerational planning or transfer, making it easy to transfer wealth across generations. So you might be a parent who's trying to help your kids into the property market, but you still want to keep control, maybe even an income stream. So particularly, I guess, people trying to protect their kids from maybe future relationships. So with a unit trust, you can hold the initial units and over time gradually sort of gift or sell those units to your kids without having to sell or refinance the property itself. So a bit of a cleaner way to shift ownership over time, all while keeping things documented and tax effective. And then I guess one of the big ones, or last big one, is the tax. So we talked earlier about the CGT discounts. There are some limitations, but if the structure is done correctly, the gains can flow through to the individual and be taxed accordingly. And also because unit trusts can be held by other trusts, so discretionary trusts, companies, self-managed super funds, you've got the ability to have flexibility on where that income lands depending on what your structure and what your circumstances are. So depending on your structure, you can set it up to be most tax effective for you so that you're paying the lowest tax rate that's possible. All right, so in short, I guess we're looking at more scale, more control, better flexibility, and better tax outcomes. Now, I guess as powerful as the syndication is or investing together is, there are some important be careful and be aware of items. So some risks and limitations. So first is land tax. In most states, like New South Wales, Victoria, unit trusts don't get the land tax threshold. So meaning you're paying tax from either $1 or from a lower threshold. And this can erode cash flow if you're not prepared for it. So just be aware of that and check that before you pull the trigger. And the second is limited lender appetite. So not all banks will lend to unit trusts, and those that do often want personal guarantees from all the unit holders, which can tie up borrowing capacity and add to your risk. So definitely speak to the POS Money team about that. And third is administration. So these structures really need a proper legal setup. They need the right trust deed. They need a corporate trustee and all of the ongoing tax and accounting that goes with that. And that does mean added cost and complexity. So it's not a set and forget deal. So you do have to be aware there's additional costs involved. And the big one is really, we see most of the time, is relationship risk. So money changes people. People do change over time. Priorities shift. If you don't have, pardon me, a watertight unit holders agreement, so even the closest mates or family can end up in dispute, as we all know. So if you're going into a syndicate, do it with your eyes open and get everything in writing up front. Have listed out how the process is going to work for exiting or if there's a dispute. So have an idea on how you're getting out before you get in. And with that, what happens if someone wants out? So this is, I get, one of the most common and definitely valid concerns. What if someone wants their money back? So one of the beauties of the unit trust is that you don't have to sell the whole property. You can simply sell the units that are in the trust, either to other investors or to a new party. And to make this work properly, you need what's called a unit holders agreement that spells out specifically how the units are going to be valued. Will it be an independent valuation, a specific formula, or a combination of the two? Whether existing unit holders have a first right of refusal to buy the exiting members' units. What's the time frame to complete the transaction? And what happens if there can't be a buyer found? Does this trigger a full sale of the property? So the agreement will be the rule book, and that's to protect everyone, to make sure no one gets sort of blindsided or stuck as well. So yes, someone can exit, but you have to do it right. And you can do it smoothly without dragging everyone else down with you as well, or with the other party. Cool. So maybe we'll talk about a couple of real world examples. So we've got one, the sibling syndicate. So two brothers and their sisters pool $800,000 together to buy a dual occupancy property in Brisbane. One of them moves overseas after 5 years and needs to cash out, and the other two simply buy their units. So no change on the title, no stamp duty triggered. So nice and clean and simple. Another case is sort of like a family wealth strategy. So parents and two adult kids pool their resources together to buy a $3 million commercial property. The parents put in most of the equity while the kids providing serviceability because they had good jobs at the time. The unit trust allocated ownership accordingly. And over time, the parents gradually gift the units to the kids, allowing that transfer without triggering the stamp duty. And there was also some other CGT concessions that were used along the way as well. So I guess, when does syndicate investing through a unit trust actually make sense? So it's worth considering if you've got limited capital but want exposure to bigger, potentially better assets, or you want access to commercial, dual income, or specialist property that's not affordable to do solo. If you've got family or trusted friends that you can work with long term, and you want sort of like clean asset protection, off title ownership, and the flexibility to enter and exit. So it is not for you though if you do want total control or don't play well with others, or if you can't agree on long-term goals with your other investors. If you're after a completely low maintenance, low cost structure, or you haven't gone and got the proper legal and tax advice. So it can be a great way to get in, but it's also an easy way to untie yourself to the wrong people and get stuck in a messy situation if you don't have an exit plan and don't think it through. So it's not just for the big end of town investing together. It's a strategy that more and more everyday investors are using to sort of scale faster, access better deals, and build long-term wealth. When structured properly, they allow you to co-invest rather than using a company. It can be much cleaner for exits and entries. And the tax side can absolutely work in your favor, particularly with access to the 50% CGT discount, as long as you meet all the requirements. But the key is structure first, investment second. Get the right trust deed, get the trustee right, and get the unit holder agreement done. It's so much easier to build the rules up front than trying to fix them later on when something does go wrong. And if you're thinking this all sounds really interesting, but I've got heaps of questions, perfect, that's great. I hope you do. And I'll be more than happy to discuss them with you. However, that's it for today. I hope you all have a fabulous day, and I'll see you next week, hopefully with less man flu and more energy. Thanks, guys. See you then.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.